Okay. Hey guys, welcome back to another stream today. So, I just found a little cafe and gonna take a look at these notes about private equity, see if I can get an intro to that. So, there's a few of these cases about private equity financing and also private equity valuation, and then a little case about the takeover of KKR and RJR Nabisco. So this is something that I kind of have to do for school, but I thought it would be kind of relevant to the investment stuff that I'm streaming on this channel. So let's dive into it. Yeah. Okay. So first one, I'm going to take a look at the note on valuation private equity. So I think this guy is a Harvard Business School professor. Paul Gompers. That's crazy. Okay, so he's an American economist. Let's take a look. Okay, so I'm going to read it just kind of in my head, and then if I see anything interesting, I'll summarize what I see.
Yeah. I can't really have a conversation. I know I'm not good at I can just.
Okay, so this is an interesting thought, that valuation methodologies can be widely applied to analyze many of the decisions that a firm faces. But he also says that anything that might affect the size or the timing of a firm's cash flows, changes in riskiness, affects the firm's value. So I'm thinking that has to do with the discount rate, also the amount of cash flows that are in the numerator, and then also the time that it takes to get those cash flows. And so that's, I guess you could say, that factor is absorbed or taken into account when you discount the rate. I guess when you discount these cash flows by exponential, so n.
Oh, they're going in. Oh, no. Northern Virginia. That's why he knows you're here.
Okay, so it seems like this guy's going to talk about two ways of doing discounted cash flows analysis. Something called the capital cash flows, weighted average cost of capital.
So if they have 3 offers, then hopefully they. Did you say to him, like what? No, but he can't. It's unethical for an agent to call our agent and say, oh no, you're 100. No, but he said you want to change. Yeah. He said not. He said you want to change. Right. I don't think. Yeah. But I think he's never dealt with it in the past. But he got counsel from. He worked with them on real estate agents area.
Okay, so there's 3 different really types of models that this guy takes us through. First is the discounted cash flows. Second, the LBO. And then finally, comparable companies. So this is like your relative valuation, multiples. Okay, so he's saying that both the CCF and WAC methods, they try to determine cash flows from operations, right? So I'm curious to what he thinks about this. So he's saying that one common mistake that students make when calculating cash flows for CCF or WAC is to take out interest payments from the cash flows and call that number cash flow to equity holders. So while this approach has merit, it is referred to as equity cash flow valuation. It does not easily allow an individual to calculate the value of the firm independent of financing and under various financing scenarios. Okay. Subscripts denote time periods. So I guess what he means by various financing scenarios is that when you have the cash flow to equity, really you're discounting that using some type of cost of equity. And maybe that changes through the different betas that you use in order to calculate the cost of equity. I think the most common way we've learned about it is through the capital asset pricing model. I'm going to assume that this professor is arguing that the way you can change the different types of capital structures and therefore calculate the different types of values for different types of financing techniques is a lot easier with the WAC because the implicit assumptions of the capital structure of a company is already built into the weighted average cost of capital formula. I think that's what he's going to say. I'm not entirely sure if he's going to talk about that, but let's take a look. So, as will be discussed below, estimating cash flows is far more important than determining the discount rate. Okay. So this is how he defines. Yeah, I think this is like the standard definition of cash flow or free cash flow. There's a lot of different ways that I guess you could think about it, but he's thinking about earnings before interest and taxes times 1 minus tax rate plus depreciation. So this is like your non-cash expenses minus capex. This is reinvestments minus changes in working capital. So this is kind of current assets minus current liabilities and plus other. So he says this is increases in taxes payable, wages payable. I guess this is other types of liabilities that you can add on to the cash flows. Okay, so the first step that he has is using what's called the CCF method. So the capital cash flows method valuation takes cash flow estimates and calculates the value of an unlevered all equity firm. Okay, so the value of the debt tax shield is added to the present value of future cash flows in an unlevered firm. So this is, I think, a pretty good point that the author makes, in that valuation in which terminal value represents a substantial majority of the value is likely to be very sensitive to small changes in growth rate assumptions. Just because this is such a huge portion of the value that it can be, I guess this is the large portion of the value that we calculate for the firm, these small changes in the growth rates are going to have substantial effects. So this is the value of the tax shield. So we have the tax rate times the interest rate times debt level. Okay, that makes sense, right? So we have outstanding debt times interest rate. That's how much interest you have to pay. And then you have the tax. So the amount of tax that is reduced is the product of all of these three. Okay, so these tax shields need to be discounted at a rate appropriate to their riskiness. If firms set debts at a level proportional to firm value, then tax shields are as risky as the firm's assets. So the proper discount rate is RA. In that case, the present value of the tax shield for the firm PVTS, having debt of DT and long-run equilibrium debt. Okay, so this is a big, I guess you could call it assumption, or maybe I don't know if you would call this an assumption, but he makes a big claim here that the discount rate for the tax shield should be the exact same discount rate as the cash flows. And that's if the debt level is proportional to firm value. So I don't know how this connection comes about. Just because the debt is proportional to the firm value, then how can we say that the tax shields are as risky as the firm's assets? Yeah, I'm not entirely sure. I'm going to come back to this. So if D is the constant level of debt, then 5 tau times RD. Okay, so I'm gonna skip this portion on this. Okay, so that's the debts. Alright, I'm gonna take a look at the LBO valuation models, and then I'm probably gonna head out from this cafe. Oop. Yeah, okay. Okay, so this is some, I guess you could say, this is a pretty good portion or paragraph that describes how this works. So the underlying theory is the same. You project cash flows or some type of earnings metric, and any positive cash flows are used to pay down debt. And so cash flows, these are what are cash flows after you've paid down interest and I believe dividends here. Okay. So any payments to pay down debt refers to actually principal payments and not interest payments. Interesting. So he's thinking that if the industry is growing more today, then exit multiples might be lower in the future than they are today. Okay. So it seems like LBO models, the main thing to think about here are 1, projected 5-year cash flows, and 2, exit multiples that you could sell your company at. Usually these multiples have to deal with enterprise value. This is kind of like the entire value of the firm, both to debt holders and equity holders. And then you could also have something here that they talk about, EBITDA multiples, earnings before interest, taxes, depreciation, amortization. Okay. So there's also an internal rate of return. That's just kind of like a geometric average of returns. Private equity investor is valuing equity in and equity out. Okay. Okay. CCCF. Okay, so it seems like the LBO method, really there's 3 things actually. So there's the multiple, the exit multiple, there's forecasted cash flows, and then there's the IRR, the internal rate of return. And kind of some underlying things to think about here are how well your forecast is, what is the growth, or you could say maturity of the industry at which your firm is at, and also what are some possible exit multiples based on whatever you know today and what you think about the future. Last is with private equity, there's going to be a lot of leverage involved, and so when you determine your IRR, that really should be determined through the equity portion of your business. So after you pay down your debt, that's going to involve forecasting the repayments of your debt and maybe also forecasting any refinancing or additional leverage that you might need to build into your model or whatever way you're trying to predict or think about the future. And there's this idea of a hurdle rate. So the hurdle rate, all it is, it's saying, look, if your IRR is 10%, you need to get this over to at least 15% in order to make this a worthwhile investment. So there's a lot of things to think about with this hurdle rate, because in the private equity space, you also have management fees, and then you also have carried interest. Management fees, just fees so that the private equity firm can run on a day-to-day basis. Carried interest is the idea that private equity firm is going to participate in some type of profit sharing program, so that if they do a good job, they'll get rewarded, and if they do a bad job, they won't get rewarded. So it's a way to sort of align incentives so that private equity firms, these are the general partners and usually a GP LP setup, they'll have the best interest of the limited partners in mind. So one final note, I might have said this earlier, but hurdle rates should be determined through equity. So not the entire enterprise value of the firm, whether or not this enterprise value is growing, but more so the equity portion of the business, whether or not that has been able to grow in the next 5, 10, 15 years. So how that actually works, this note doesn't really dive into. So maybe this is the part that I kind of glossed over. Value created by the interim pay down of debt is captured by subtracting a lower debt number. Okay, and there also might be some type of financial engineering in this, in the sense that you could, in a sense, maybe buy out multiple companies, squish them all together, restructure their balance sheet, and then attach a higher multiple than what you had previously paid for. So there's all different types of strategies involved here. I think this is an interesting idea. Could be worth exploring later. So I think my computer's all charged up. I'm gonna head out now, but thanks for tuning in to the stream, and see you guys in the next one, probably in an hour or so.